Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And it is my great pleasure to introduce the power and magic of compounding, a series that we've done here on the FastGraphs Value U Academy. In part A, I introduced the concept of the rule of 72 and tried to give some insights into just how powerful and even magical compounding actually is. In part 2 or part B here, I'm going to ask Bill Kay, Professor Bill as I like to call him, to go ahead and dig a little deeper and get in more into the intricacies of the power and the magic of compounding. Bill's going to use not only some more conservative, but you might say more realistic examples of how compounding works and how important it is. And he's going to give you just a little more in-depth understanding of the subject. So without further ado, I'm going to turn it over to Bill. Take it away, Bill.
Thank you, Chuck. Let's talk about the power and magic of compounding. So some questions for you. Would you rather have a penny that doubles each day of a month or $1 million now? Well, most people would probably say $1 million. Time value of money, I can invest it and make something off of it. However, the power of doubling with compound interest. So what if I was to give you $1 each day during the month of July? How much money would you have at the end of July, July 31st? Well, it would be $31. Now, what if I gave you $1 on July 1st, $2 on July 2nd, $4 on July 3rd, and so forth? Doubled it every day during the month of July until the end of the month. How much money would we have then? Well, most people would not guess this amount. The power of compounding and doubling. We would have $5,368.7, $5.37 billion at the end of July. Amazing, the power of compounding. Yes, if we can double our money, and this is something we always watch in investing. Albert Einstein, the genius, noted that one of the most powerful forces in the universe was the principle of compounding. The force that manifests itself through the concept of compound interest. Compound interest simply means that we begin to earn interest on the interest you receive, which multiplies your money at an accelerated rate. We're going to see this in action. So if I was to take $1,000 and I could find a nice safe investment earning 8% per year, I would have $1,080 after 1 year. Now, then if the 8% interest on the $1,080, I let that roll into the second year, I would earn 8% on $1,080. That's another $86.40. So I've gained an extra $6.40. So I would have $1,166.40 after 2 years. With compound interest, you can turn $1,000 into $2,000 or double your money in approximately 9 years. Approximately. So next we're going to look at how many years does it take to double our money. So we can double 1,000 into 2,000 in about 9 years at 8% compound interest. With simple interest earning $80 per year, we said we could turn 1,000 into 1,080 after a year. After 40 years, we would earn $3,200 in simple interest on our money and be up to $4,200. However, with compound interest and letting the interest earn interest on the interest, you can see we're going to double our money in just less than 10 years. And at the end of 40 years, instead of $4,200, we ended up with $21,725. Yeah, we double it 9+ years, and we've gained an extra $17,525 over the 40 years. The rule of 72. Actually, some people call this the rule of 70 or even the rule of 69.3, but just as a rough estimate of how long does it take to double your money, you divide the interest rate into 72. So if we take the interest rate of 8 into 72, it comes out to 9, approximately 9 years with compound interest. That's the key. With 5% interest, it's going to take you longer. It's going to take you 14.4 years. As we said, 9 years at 8%. If we can get 10% return on our investment, it's down to 7.2. And if we could get 12%, we're down to 6 years. So the more we can make, the shorter time to double our money. That's the key. Now here is a future value table. And I'm going to look at turning $1 into $2 or doubling our money. Lots of numbers on this table, but let's look at this. If we have a return of 5%, and the returns are at the top, the number of periods or years are down the left side, you can see that you can double your money in between 14 to 15 years at 5% return compounded, 14 plus years. Now, if you could make 8%, let's go up to 8%. There's your 9 plus years right in there, between 9 and 10 years. And then if you go up to 10%, it's 7 plus years. And now if we jump up to that 15%, we can double our money in less than basically 5 years. Key to success. So what are the elements that determine your compound interest returns? Number one, higher interest rate you can earn on your investment. But remember risk versus reward. The higher the return, usually the higher the risk. Time. This is one of the keys. Start young. Start as soon as possible. Time is something that really helps multiply your returns. Also, if you can invest in something tax-free, open up a 401k plan. Because if you don't have to pay taxes, that's going to help multiply your return and your amount you're going to receive, or you can take out when you retire. Also, we have to take into consideration that inflation is going to eat up 2 to 3% of our return every year. This is standard inflation rates. Over the last 87 years, we look at investments, and actually small company stocks have done the best. They've shown 11.7 return. So you could turn $1 if you had invested it way back in 1926 into $16,976, almost $17,000 over that time period. Now with the S&P index, 500 index, it's shown an average return of approximately 10%. In fact, the total market, sometimes people say between 8 and 10% return. Good years, bad years, average, around there. Now, remember risk and reward. If we decide to go to bonds, less risk, intermediate bonds have given us about a 5.3% return. We've only turned $1 into $93 there. You can see the difference. And then if you go to real short-term U.S. Treasury bills, you're only earning 3.5% over this time period. And there you're only turning $1 into $21. Higher risk, higher return. U.S. Consumer Price Index is about 3% per year. All right, so let's look at a tool that's offered to us by the U.S. government. If you go to the website, investors.gov, and go into Financial Tools Calculators, there's a great calculator that lets you look at these things. We can use compound interest calculator. So let's say Jill starts early at the age of 21, and she doesn't have much money at that time, but she's a real prudent person that's disciplined, and she can put away $400 per month. She's got a job, and she saves $400 per month. That's not bad. And she's going to let it sit there for 46 years, from 21 to 67. She's going to retire at 67. So you can see on the right, initial investment $0. She's going to put the $400 in monthly 46 years, and she's figuring an 8% interest rate return. She's pretty conservative and no interest rate variance range, and she's going to do it annually. What's going to happen here? How much money is she going to have at 67? Well, she's going to put in approximately $220,800 at $400 per month over that 46 years. And with compound interest, when she retires at 67, she's going to have over $2 million. Not bad, turning 220,000 into 2 million. That's just at 8%. So you can see the chart that they show us in this tool that the U.S. government gives us. Starting with zero, putting in 400 per month or 4,800 per year with compound interest at 8%. And there's the ending balances, the 228 she puts in, and the over $2 million at retirement. So she contributed that, and she ends up with the 2 million plus. Now, if we would have invested in a great company like Lockheed Martin, LMT, and I go to Fast Graphs and I look at this chart, and here is an A- rated company. At this time, they're paying a dividend yield of close to 3%. They got their blended adjusted earnings yield above that 6.5, that 6.86, which is good. And right now, their stock is selling for $356.03 per share. This was as of December 18th, 2020, recently. Now, if we would have been able to start way back 20 years ago, we could have bought the stock at a split adjusted price back on 12/29/2000 of $33.95. So we have really seen a lot of appreciation in the stock price over the years, with it ending just a few days ago at $356.03 per share. Not a bad growth rate. And they also have been paying us a dividend. So let's go to the performance area of Fast Graphs and look at this. If we would have had the $10,000, this is always a challenge, but way back in December, into December 2000, we could have invested the $10,000 at $33.95 split adjusted price and ended up with 294.55 shares. Now, if we would have taken out our dividends and not reinvested it over the years, you can see that we would have taken out $22,209.05 in green over the last 20 years. Now, the dividend growth rate over this period of time has averaged about 17.8% or 17.2% compounded annually. Not bad. And we have turned 10,000 into, got that 294.55 shares, now at $356 a share. We have over $104,858. This is without dividends. You add the dividends in, you're going to come up with that we've taken out $127,077 plus. That's a rate of return of 13.6%. Not bad. However, the key to success is if you don't need the money, reinvest the dividends. Dollar cost average in over this 20 years. Same thing, we invested the $10,000 into December 2000. We had the 294.55 shares. But if we would have let the company buy more shares with that dividend, look at the growth in the number of shares. Started with 297.8 at the end of 2001. Then we go up to the ending period. We're up to 482.3 shares. This is the key to success. Now you take the 482.3 shares times the ending price of $356.03, and we're up to $171,702. That's great. That's a 15.3% rate of return. That's with your dividends reinvested. So with dividends reinvested, we have doubled our money approximately every 4.6 years. That's with a 15 plus return on investment annually. Key to success, the power of compounding. If you can find great companies and buy them basically when they're underpriced, do your research on fast graphs, start young, just let your dividends reinvest. You can accumulate wealth and retire without worrying about money. Thanks, Chuck.